We're going to address IRAs and RMDs. IRAs, individual retirement accounts. RMDs are required minimum distributions that are imposed by the IRS. If you have an IRA asset, once you turn age 73, you are forced to start taking withdrawals from the IRA. The moral of the story, the IRS wants your tax dollars. They want you to start getting into that IRA, pulling funds out, because at the point that they come out of the IRA, they're taxed at your ordinary income tax rates. The RMDs are increase every year. So each year that you get closer to your life expectancy, the IRS forces you to take a higher percentage out of your IRA. So they're designed, number one, to release ordinary income so that they get their hands on income taxes. Number two, bleed this thing down to next to nothing so that they can capture those tax dollars and that tax revenue during your lifetime. If you live long enough, the withdrawal rate that's imposed runs this account down to next to nothing. So the issue, one of the big issues we have is that most folks that have an IRA aren't aware that this is designed to go down to nothing. So this is an asset that more often than not much is left to pass on to your beneficiaries, whether that's a spouse, surviving spouse, kids, grandkids, loved ones, a charity, whatever it may be. So there's a couple of strategies that are very important to address. Let me reemphasize, very important to address earlier rather than later. With the RMDs, one of the things that we need to do when you look at this asset is understand that you don't have to wait to 73, but you do have to start taking withdrawals at 73. Since we are in a progressive tax system, each incremental dollar that you take out is taxed at a higher percentage because of this progressive tax system that we've got. So if we look at this IRA asset and somebody starts at age 73 and say they live to 90, that's a 17-year distribution period. Don't have to wait to 73. If you start at age 60, for example, and you're taking withdrawals from 60 to 90, you can spread those payments out over 30 years instead of squeezing down into 17 years and potentially paying a much higher rate of taxes. Two strategies that are very important to look at with your game plan. And we would recommend looking at this as soon as you turn age 60. So it's never too late, but age 60 is an ideal time to lay out your game plan from a tax standpoint, from a estate preservation standpoint. One feature that's available, at least at this point, is a systematic conversion over to a Roth IRA. Roth IRA has some features that are much more beneficial than a traditional IRA. Roth IRA is a tax-free retirement account. There are not minimum required distributions on that account, which allow you to, when you do take withdrawals from a Roth, they're not taxable. Secondly, when you pass that asset to the next generation or your heirs, your beneficiaries, that's not taxable either. So there's a systematic formula to start unwinding and moving those assets. Sometimes, depending on your personal situation and your taxable income, those dollars can be converted to the Roth with no tax implications. The second is an estate planning strategy, in which case you can, using an example of someone with $500,000 in their IRA, you can start with the 500. You can protect that 500 so that at least you know that at least 500 will be passed along to your heirs even after you've taken the required minimum distributions. If you live 2 years or you live 50 years, once you turn on the income stream, those beneficiaries, there's an estate planning strategy that those beneficiaries can get the 500,000. So again, it's not too late at 73, but you can position yourself to save tens and tens of thousands of dollars in taxable income and pass along a much larger percentage of your IRA asset if a game plan is put into place in time. So you've got, regardless, Most people will wait until they're 73 and just start taking the minimum distribution each year with no plan to protect the asset or to minimize taxes. If you start now, you can maximize your income, minimize your taxes, and preserve that asset for the next generation. Very important to address this. Doesn't cost anything to look at it. Can't overemphasize the importance of determining a lifetime game plan for the distribution of those assets to yourself and to your next generation and your beneficiaries.